Hello and welcome to the Davidson Institute's recorded webinar, Homeowns Getting Ahead. Our home is our castle, but it can be so much more than that. This presentation is about looking at our financial journey and thinking about how we manage our finances and mortgage to use our home to get ahead. Now, we all want to get ahead financially, and I think the best way to do that is to understand how our finances change throughout our life, and to be able to effectively plan for the future that we want. So we're going to have a look at a typical financial life cycle. So in the early years, as we're starting out on our financial journey, we're increasing our income and assets with our first job, buying a car, and so on. Now during this time, it's important to start developing good money habits. As our working life continues and we start to establish long-term relationships and take on long-term commitments, our wealth tends to fluctuate depending on career and life events that either contribute to or use up our cash flow. While we're getting established and starting to create some long-term wealth, we need to have a focus on saving to ensure our commitments can be met. The next stage of our financial journey is where we are building and optimizing our wealth as we're preparing ourselves for life after work, or more specifically, life after we stop earning an income. And during this time, there are lots of different events that are going to take place, like putting the children through school, perhaps buying an investment property. There may be changes to the family situation. And then as our children move out of home, we may need to help them financially as well. But of course, throughout this time, for our own personal situation, it's about maximizing our wealth, as this is what's going to sustain us during our retirement. Then of course comes the day when we finish work and life changes significantly. At this point, if we want to do all those things that we've saved for and built up our wealth for, if we want to travel or do community work or simply spend more time with grandkids, we still need to manage our wealth and the income from it to ensure it lasts our lifetime. So this presentation on getting ahead focuses on one of the most significant financial decisions many people will make, and that is to buy a home. This is a commitment and an opportunity that will last most of our working life as we're establishing, creating, building and optimizing our wealth. So we're going to explore ways to manage the debt that often comes with purchasing a home. We're going to look at ways that we can leverage the value in our home to improve our wealth position. And then finally, how can we plan to make the most of our situation? So let's start by looking at some ways to manage the debt that we may have against our home. Now, to my way of thinking, there are three key elements that we can use to reduce the cost of our home debt. Firstly, interest rates. Secondly, repayments. And thirdly, an offset facility. So let's explore each of those in more detail. Firstly, interest rates. Now, getting the lowest rate possible isn't always the best scenario, as we need to look at what we might be missing out on to get that lower rate. For example, other benefits such as the ability to pay more frequently. Now that said, it's worth exploring whether taking up a honeymoon rate at the beginning of a loan might be helpful in getting ahead. Be wary though of any restrictions or other costs that might follow on from that honeymoon period. Now, many financiers now offer packages such as a bundle of products with discounted rates that attract an annual fee. But do your sums and check whether the discounts outweigh the cost of the package, because these discounted rates can be a great way to reduce the cost of your loan and get ahead. Now finally, let's take a look at fixed and variable rates, because this is probably one of the most asked questions when it comes to home finance. Should I go fixed or variable rate? So let's start with what's the difference. Well, as their name suggests, variable rates will fluctuate over time, generally in line, though not always, with the official cash rate set by the Reserve Bank. Fixed rates, on the other hand, are fixed for a specified period of time. So this has the effect that repayments are also fixed for that period of time, making it easier to budget and manage your cash flow. However, because your rate and repayments are set at a specific level, you're generally not able to make higher repayments than those agreed without incurring a penalty. So locking into a fixed rate also means that if the cash rate falls, then you don't get the advantage of the reduced rate. Variable rates, on the other hand, while it may mean that your repayments can increase or decrease because you're not locked into a set repayment amount, as long as you pay the minimum required, you can set your repayments to suit your situation and make extra repayments when you've got the money available. Now, if we were to look at an example, now 7 years ago, the Westpac 5-year fixed rate was 7.19% per annum, which at the time was significantly higher than the variable rate of 5.81% per annum. However, as you can see, over the next couple of years, the variable rate increased to a peak of 7.85% per annum in November of 2010. So anyone who locked into the 5-year fixed rate wouldn't be bearing the added interest cost at this point. However, come May 2012, when the variable rate dropped below the 7.19% again, then neither would they enjoy the decreased cost. There are advantages and disadvantages to each, and it depends on what's happening in the economy generally and your personal situation at that particular point in time as to which is going to be the best option for you. Now, in a bid to take advantage of the best of both worlds, it's not uncommon to see people splitting their loans with a variable and a fixed portion. So let's have a look at an example. Now, Leah and Jordan purchased their home for $470,000 in July of 2009. They had saved a deposit of $95,000 and took out a home loan of $375,000. The variable rate at the time, as we just saw, was 5.81%. But because they believed that interest rates were going to go up in the future, they decided to fix $250,000 of their loan and leave $125,000 at the variable rate. Now, the options they considered at the time were a 1-year fixed rate of 5.49% or a 2-year fixed rate of 5.99%. Now, they elected to fix for 2 years at 5.99, even though the rate was slightly higher. Their decision proved to be a good one, as in October, just 3 months down the track, the variable rate increased to 6.06 and continued to increase over the next 12 months to a peak of 7.86%. So this is an example of how we can split a loan, part fixed and part variable, depending on what our circumstances are at the time. Now, not only did Leah and Jordan enjoy a lower fixed rate than the prevailing variable rate, they were very happy to have the consistency of repayment amount on the larger portion of their loan, but still be able to make extra repayments when they had the cash available on the variable portion of their loan. The next element to consider in managing your loan to reduce your costs is your repayments. So what difference does it make if you make fortnightly repayments instead of monthly? And what difference can additional repayments make? So let's start by looking at increasing the frequency of repayments, specifically paying fortnightly instead of monthly. Now, in the example on the screen, I've used the Money Smart How Can I Repay My Loan Sooner calculator to demonstrate the difference. I've looked at a home loan of $500,000 at a variable rate of 5.24%. And we can see that by making repayments of half the monthly repayment on a fortnightly basis, we can significantly reduce the overall term of the loan and the interest costs. The overall term can be reduced by 4 years and 9 months, and the potential interest saving is almost $90,000. So the time and interest savings are generated because the more frequent repayments reduce the principal more quickly, which reduces the interest that's calculated on the amount. Now, another option for some is to make repayments higher than the minimum required amount. And again, this has the effect of reducing the principal more quickly and thus the interest calculated too. In the example on the screen, we can see we've got the same loan amount of $500,000, the same interest rate of 5.24% with monthly repayments of $2,800 over 30 years. Now, by paying an additional $200 a month, roughly $50 a week, again, the savings in terms of time and interest are significant. So if you're able to squeeze some extra repayments out of your budget, it's definitely worth it in the long run. If you are going to make additional repayments though, check whether your bank has a redraw facility that may allow you to access those extra repayments should you need to. And remember too that if you decide to fix your interest rate, you may not be able to make more frequent or additional repayments without incurring penalties. So make sure you check that out before changing your repayment arrangements. That then leaves an offset facility as the final element to help us manage our home loan and reduce the cost. So let's have a look and see how this offset facility works. So remember, Leah and Jordan have a fixed rate loan of $250,000 and a variable rate loan of $125,000. They've also received an inheritance recently and have a savings account with a balance of $25,000, earning interest at 2.5%. Now, leaving the fixed rate loan out of the equation because the offset facility is only available on the variable rate loan, let's calculate the net effect of interest earned on the savings account and interest incurred on the home loan. So let's assume that they're not going to add anything further to the savings account and that they will not withdraw any of it for the next 30 years. How much interest would they earn? Well, at 2.5% per annum, they'll generate $27,884 of interest over the next 30 years. So in effect, they'll double their money. Now let's have a look at the home loan. If Leah and Jordan continue paying the minimum repayment due each month, they will have the loan paid off in 30 years. During that time, they will also have paid $130,562 in interest, more than they've actually borrowed in the first place. So this then gives them a net result of interest incurred of $102,678. So the question before us now is there a better way to manage this scenario? And here's an alternative. Instead of putting the $25,000 into a savings account, what if they put the $25,000 into an offset account instead? Now you'll notice there on the screen that the offset account doesn't earn any interest. So you might be asking yourself, well, why would I do this? Well, the structure of an offset is that any balance in the account acts as if it had been paid off the amount owing on the home loan. So in Leah and Jordan's case, instead of interest being calculated on the $125,000, it's only calculated on $100,000. So what does that mean for them financially? Well, here's the big difference. Now, you don't receive any interest on the credit balance of $25,000. However, instead of paying nearly $130,000 in interest over the term of the home loan, they will only pay just a little over $61,000. That's a saving of nearly $69,000 over the life of the loan, which, by the way, is now 21 years and 11 months, not 30 years. So as I said, any credit funds sitting in the offset account reduces the balance that interest on the home loan is calculated on. The offset account operates in exactly the same way as a transaction account, meaning that you can have your salary deposited into the account, you can withdraw or transfer what you need as you need it, but in the meantime, any balance held in that account is reducing the interest accruing on your home loan. So here we've explored a few ways that you can save some dollars on your home loan to help you get ahead of the 8 ball. Now let's have a look at how we can leverage that asset, our home, to earn more wealth for us instead of simply being a drain on our cash flow. Now in theory, two very specific things happen with our home over time. Firstly, the value of the property itself increases. And secondly, we repay the mortgage or the loan. As time progresses, the gap between how much the property is worth and how much we owe on the mortgage increases. Now, many homeowners are already increasing the size of their gap by using some of those tactics that we've just looked at, like the offset accounts, accelerated repayments, and so on. However, not all of them are using that gap to their advantage by leveraging the growth in the equity in their asset. So that's what we're going to explore a little further, because it's no great secret. It's just about having a little more knowledge and the mindset of planning rather than hope or a bit of luck. So to illustrate this and how we can take advantage of it, we're going to use another case study. So Amber and Craig purchased a 3-bedroom home for $400,000 3 years ago. They've decided to use the available equity in their home to grow their wealth. Now, growth in property values in their area has averaged 4% per year. Let's have a look at how this works in a practical sense for Amber and Craig. Firstly, let's look at the growth in their property value. So as we said, currently property is growing at an average of 4% per annum in their suburb. Assuming that this trend continues, 30 years after they've purchased their home, it'll be worth $1.2 million. That's a 300% increase in the overall value of the property. Secondly, let's look at repayment of the mortgage. Amber and Craig are paying off the minimum monthly repayment with the intention of having the loan paid in full over 30 years. So after 30 years, the property will be worth $1.2 million and they will owe nothing on it. Now, from a banking perspective, this equity is valued at 80%, meaning that Amber and Craig will have equity that they can access in the value of $960,000. So at the end of the 30-year period, there's $960,000 in available equity. But Amber and Craig don't want to wait for 30 years to access this equity. They want to be able to access it now to either use to support a chosen lifestyle or perhaps take advantage of investment opportunities. And this is entirely possible because throughout the life of the loan, there's an ever-increasing amount of equity available. So based on our assumptions of a 4% annual growth in property value and minimum monthly repayments being made on the home loan, and that equity is valued at 80%, let's have a look at the equity that Amber and Craig may be able to access. So they've now owned the property for 3 years, and that would mean they would have approximately $50,000 available in equity now. After 7 years, they'd have approximately $130,000 in available equity. And after 15, $475,000 in equity. So if that's how Amber and Craig's equity changes over time, let's now overlay the diagram with our financial life cycle segments. So for Amber and Craig, the segments that are relevant will be creating, building, and optimizing wealth. So this is where our planning for how we can use the equity or leverage the equity in our home can now kick in. So by considering what are the likely events that will occur throughout our asset's life cycle, we can gain an understanding of approximately when you are likely to need to access money. For example, they'll have a rough idea of things such as marriage, travel, kids' education, and so on. And then we're able to consider what potential opportunities exist to use the equity as a wealth building platform. So for example, at about year 7 is potentially where the children may start school. So Amber and Craig have the opportunity at this point to use some of the equity they've built up in the home to perhaps pay for private schooling or tuition. Or they may decide to wait a little longer, say 10 years, and decide to use the equity to help them to purchase an investment property. So by recognising that our home is not just our castle, but an asset that we can use to improve life in other ways, we're then able to plan for the options that this opens up for us. So what are some of those options? Well, firstly, I think a home gives us accessible equity, and we've just seen that. So equity is the value in the asset, in this case the home, that's available to us to leverage for other investments. By planning effectively and choosing our investment wisely, we can be in a stronger position to grow our wealth. For example, we may have made additional repayments to our home loan and are ahead, then we may be able to redraw against our home loan to purchase some shares perhaps. Secondly, a home gives us borrowing power. The equity that's built up in the home can provide additional security for an investment property instead of having to save a cash deposit. Thirdly, a home can give us the freedom to choose. Not every decision is a purely financial one. For example, we may choose to use the equity and/or our borrowing power to fund a private school education for our children, or even take a well-earned holiday. And finally, a home gives us security. There's an old saying that into every life a little rain must fall, which is simply acknowledging that things aren't always going to go to plan or as we would like. We don't know when these adverse events are likely to occur, but it's a great comfort to know we have something to fall back on. Being able to access funds should we need to travel unexpectedly or if there's an accident or illness provides us with security and peace of mind. To be able to make the most of these options, though, is going to require some careful planning. But I think it's definitely worth planning for the best. So we started out this presentation by looking at how our finances and the way we manage them change over time. When we're starting with all those firsts, if we establish some good money habits, then they'll stand us in good stead for the rest of our lives. Then we spend a number of years working, and our financial position will fluctuate throughout this time depending on how we're using our money. But we need to be conscious throughout this time of steadily building and then optimizing our wealth so that when we are no longer working, we have sufficient to provide for the lifestyle that we want. So I'd encourage everyone to take a look at where you are currently on this cycle and to consider what actions you're currently taking, what you have coming up, and whether you may need to change anything. Now, it's only through actively planning for our future that we can potentially have the future that we want. So during this presentation, we've had a look at some techniques to manage your home loan and make it work to your advantage. We also looked at using your home to generate more wealth, both of which can help you to plan for the best. So thank you for viewing our recorded webinar, Homeowners Getting Ahead. I trust you found the information presented useful and relevant. I thoroughly recommend you checking out the other webinars and guides on the Davidson Institute website for more information to help build your financial confidence. Thank you for viewing our recorded webinar, and I wish you every success in getting ahead with your home loan.